let's talk about the markets again, because you have a long-running bet that's almost up. It's in the final stages, the last year of the bet, about what does better, the S&P 500 index over 10 years or someone who you made a bet with for $1 million who got to go pick 5 hedge funds. He created a fund of funds based on 5 hedge funds. And between the two of you, the S&P 500 index has been the massive outperformer over the 9.5 years of the bet.
Yeah, it'll absolutely kill every one of the fund of funds. And bear in mind, each one of the fund of funds had a strong financial incentive to pick the best funds they could find 10 years ago. I mean, it meant real money to them. Yeah, so it was overwhelming. And passive investment, you know, I've written about it. Passive investment in aggregate is going to beat active investment because of fees.
You did this as a result because you wanted to show people that they didn't need to be trying to beat the market all the time, that they could just be investors over the long haul, and that would be a way to make money.
And that they didn't have to pay 2 or 3% a year to somebody to get those. And average results were going to be very good.
Right.
And they were good. They've been good all my life, and in these 10 years they've been good. You've done perfectly okay with passive investment.
Actually, you've done great with passive investment, especially the last 7 or 8 years. There are people out there who are saying, oh, he just got lucky. He picked the right 10 years. He did it right before quantitative easing came along. There's a guy, Mark Yusko at Morgan Creek, who's been saying he wants the next 10 years bet and thinks he can outperform in that time. What do you say to somebody like that?
They'll put up a substantial part of their net worth. I get letters all the time from people who say, I'd like to do it. I'll put up $100 in, you know, or something. They'll become famous. So they love the idea of me giving them a lot of publicity. If anybody wants to put up a significant percentage of their net worth,
$1 million, does that cut it still?
It just depends on their net worth.
Okay.
But if they want to put up a significant percentage of their net worth, their family's net worth, and they want to make a bet on 10 years on active versus passive, you know, maybe that my estate has to be the one to settle with them. I mean, at 87, anything involving 10 years is kind of a triumph of hope over statistics. But nevertheless, the ones that have written me, they really want to get their name in the paper, you know, basically.
But you'll take anybody who puts up a substantial portion of their net worth. You'll take that bet.
They can pick a group. You got to pick a group, you know, because I'm picking a group of 500 in the S&P, and they can pick the date of the start. The date of the start had nothing to do with it. And the truth is the markets behave fairly typically in terms of aggregate return for the decade. This is not some extraordinary period in the least. There's nothing unusual about this. The thing that was unusual was the size of the fees, and that's ate them alive, basically. Right. The managers of these funds did very well during this period, and the managers of the underlying funds did very well, and their investors got killed compared to something they could have done.
To further buttress the points Warren Buffett made, check out this headline in November of 2021 when this video is being filmed. Downfall of star hedge fund reveals Brazil at tipping point. Okay, so I'm going to be talking about the alternatives to investing in ETFs and why those alternatives may not necessarily beat the standard ETFs that we already know. And I'll be telling you what I think you can do for your wealth to help you in 2022 and going forward. But before that, guys, if you don't mind, please hit the like button and subscribe to the channel. It's a growing channel. I appreciate the support. I've been getting a lot of views, but I've observed that of the 100% that view my channel, 98% have not subscribed to the channel. I will appreciate your subscription, and I will appreciate you giving me 1,000 likes on this video. So play your part to making that happen as a support to the Nick Finance Clips channel. Thank you. With that said, let's delve deeper into this headline. As interest rates soar, appeal of hedge funds is fading fast. Guys, there have been a lot of funding type, there's been a lot of structures that have come out over the years, but nothing beats the simple investment in the 500 big companies in the US. Now, this fund has seen its assets under management plunge a whopping 90%. Now, to bring that home, imagine that you gave $1,000 to this fund manager. In this particular time frame, your $1,000 would have technically reduced to $100, and that's even excluding the management fee, which will still be charged on top of the losses. So you really see a case where investors are trying to fly out of this type of funds because they're getting their fingers burnt. Check this out. investors are getting scared and jumping out of high-risk funds. Okay, that's what the finance professor said. Brazilian investors have anticipated next year's turbulence and gone back into fixed income, which is in their DNA. So there's that flight to safety, that flight to fixed income securities, which are securities that do not have the risk profile that equities have. Okay, now to buttress further, for individual stock picking, you would see that on a day like this, when the market is down about 2%, okay, you see the S&P down 1.72, Dow down 2.25, Nasdaq down 1% thereabouts. For some individual stocks, they could go as low as 6%. Now, this is using AMC as an example. Now, there are other stocks that are up today, but there are stocks that are down well below even this 6%. So that buttresses the point that fund managers that take funds and invest in exotic securities or try to do stock picking, and individuals that try to pick stocks individually sometimes may never see the returns they get by putting their money in simple index funds. Personally, I like stock picking, definitely, but at the same time, I recognize the crucial importance of investing in index funds. And in this video, for those that don't know already, I believe that the two best index funds right now, which should go into my portfolio in 2022, will remain the Spider S&P 500 ETF fund and the Vanguard S&P 500 ETF fund. Now, I've done videos explaining in details why I prefer these two funds and which of these funds I think will do better than the other one. So you might want to check out the video in the cards that will come up shortly and also in the description. Now, to summarize something for those that don't know, when you check the expense ratio of these funds, you will find out that Vanguard has a lower expense ratio compared to the SPY, and that's why I probably will do more allocation to Vanguard than the SPY. Okay, now to answer a question that came up on the channel, okay, what about other assets, Bitcoin, Ethereum, other exotic assets? The point is this, guys: if you want to invest in securities or instruments that would allow you sleep well at night and not bother checking their price movement every day, logging into your account to monitor, then you want to invest in instruments that have a risk characteristic that averages out the market noise. For example, if you take the S&P 500 fund managed by SPY, you will see that there's a diverse pool of stocks ranging from different sectoral allocations, okay? You have basic materials, you have healthcare, you have energy, you have technology. So if one sector goes bad in 2022 or thereafter, you will not find yourself suffering a steep loss compared to investing in assets that are very risky and not properly diversified. So to answer your question, while you can invest in cryptocurrencies subject to your due diligence, keep in mind the fact that when there's a downturn, you will see a materially brutal loss compared to what will be obtainable if you keep your funds in an index fund. Wrapping up, to hold a fund forever or to invest in a fund forever, it must meet the criteria of being a fund that will be well diversified, have a reasonable expense ratio, have professional management, and also give you that leeway to not bother much about the risk. And all of that criteria are pretty much met by the two ETFs I've spoken about in this video. But I'd really love to hear from you guys. What's your best ETF? Would you like a video on more ETFs beyond these two ETFs? Would you like me to talk about dividend ETFs? Would you like me to talk about different types of ETFs? Let me know in the comment section. All right. As always, like I said earlier, if you don't mind, please subscribe to the channel and also like the video. Get me to 1,000 likes on this video so that more people can see what's going on the Nick Finance Clips channel. Thanks to you. With that said, thanks so much for stopping by again, and hopefully I'll see you all again in the very next video. Cheers, guys.